Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic morning or afternoon, or guess depending on where you are, maybe it's evening. Also want to give a shout out and say hello to anybody watching the recording of this webinar. If you're on YouTube or if you're on the calendar, just want to say hello to you guys. If you're here live, feel free to ask any questions throughout the webinar in the chat box function. If you're watching this in the recording, feel free, or on YouTube, like I mentioned, feel free to ask questions in the comment section down below, and I can get those questions answered for you guys. Well, great. Like I said, welcome everybody. I had a request today that we talk about some of our price action basics. So I want to go over some of the essence of price action trading and what you should be looking forward to and looking for when you're trading price action. So I really want to make this a pretty special webinar today. And like I said, feel free to ask questions as we go along. But before we jump into our presentation, as always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. And also, if you are new to the program, let us know what state you're from or what country you're from in the chat box. Or if you're watching this on YouTube, feel free to let us know where you're from, what state or country you're from in the comment section down below. All right, guys. So like I said, we want to talk about price action basics. So let's actually jump over to a chart and let's go over some of these basics. So I want to do a little ranking, and let's see, maybe we can just draw this out here. So let's talk about all the different things that we look at when we're studying price action. Now, first of all, what is price action trading? Price action, in my definition, would be when you're looking up a chart of any financial instrument, can be currencies, futures, commodities, stocks, bonds, any market that you want to analyze, you're looking at the chart. And most charts look something like this down below, that they have a bunch of candlesticks. Um, you've got lots of different, you can actually pull up lots of different types of charts. So candlesticks look like this. And this is just the price of the market, and they indicate whether the price is going up or they indicate if the price is going down. So that's price action, because you're seeing price in its action, in its environment, moving forward, doing what it does. That's what this is here. Now you also have different ways of viewing price action. You can, here in TradingView, you can actually come up here to the top. There's this little ribbon up here of different things you can select. One of them is right here, and you can, if you click on it, it brings down this drop down of different options. So candlesticks are probably the most common way to view a chart. And these, like I said, this is a bar, here's candle, and these are candlesticks right here. Basically, candlesticks indicate what the market did in a specific period of time. So you'll see, these candlesticks have these bodies on them that are red or green. A red one indicates the market moving down. A green one's where the market's going up. You'll notice they have some of these lines on them. These are called wicks, or shadows, they're also called. I don't hear them called shadows very often. They're mostly called wicks. So this one kind of points out over here. What that means is during this period of time, the market really pushed up a lot and then couldn't sustain the price action and pulled right back. Okay. Um, some of these candles, like this one's a little more solid right here, solid red, not a big wick on the top or at the bottom. What that means is during that period of time, pretty much the market just went straight down and then closed down, and then a new candlestick was born at that point. So those are candlesticks in a nutshell. We actually have a class on candlesticks that you can go back and watch if you want to learn more about candlesticks and how they work and the different candlestick patterns. I've got several webinars you can go back and watch. Just, let me know, shoot me an email or ask down below in the comment section if you have questions about the different types of candlesticks, and I can get you a video to that. Okay, so there's that. Then you have the different types of charts. So this is known as a bar chart right here. Bar charts are probably the next most common way of looking at the price action. And I'm not a big fan of them. You'll never see me using them just because I feel like the candlestick is a superior format of viewing the price of the market. And they basically do the same thing as candlesticks, but they're not as, uh, I guess, 3D. Like these ones, you can see where the wick starts and ends. There's a little nick at the bottom of them or at the top of them that you can kind of see, right? Those are bar charts. Then you have Heikin-Ashi charts like this. And the whole idea with Heikin-Ashi is to look at charts as far as like they try to draw out more of a trend with these candlesticks rather than a mix of candles. So the whole idea with Heikin-Ashi is if you have a green bar, then the next bar you'll buy, and then if you have a red bar, then the next bar you'll sell. That's a concept with Heikin-Ashi. It's the same thing with what are they called? I forgot the name. It's the same thing as Renko. Renko does very similar things as Heikin-Ashi. There's hollow candles. They're the same thing as candlesticks, but now they're hollow. That's the only thing that's different. Then you have line chart. I would actually say this is coming back into play. A lot of people are starting to use line charts a little bit more, I've noticed on YouTube and other places. Line charts kind of ignore the candlesticks, and it's just giving you a line of where price is. So line charts can be useful because it kind of ignores some of the other things. But they also can be confusing. So it's important to note that as well. Just depends if you want to use it or not, a line chart. And there's other different times. This is called a step line. You've got an area. Let's see, this is columns. Yeah, not really interested in that. So I would either do, if I were you, I would do a candlestick chart, which is what I'd mostly do, or I would do a line chart. Okay, when you're viewing price action. Okay, so now let's talk about other price action concepts, and we'll kind of move and develop on our discussion. So when we're discussing price action, there's a lot of different things people look at. So let's actually label some of these things. So people look at support resistance, right? Does everybody know what that is? Support/resistance. Okay. Support is a place where the market likes to come and hang out. So and then bounce up on. And then resistance is an area that the market likes to hit and then bounce down. Okay. So right here, this would be an example of resistance because the market came up here, pulled down, came up here, pulled down, came up, pulled down. That's resistance, right? Support would be the opposite of that, where it looks like right around here, the market likes to come down, touch here, come up, come down, comes up, comes down, touches there, and goes back up. That would be support. Okay. So that's a really common price action, concept that we need to understand. Okay. The other thing that we want to look at is, let's see, there's other different things you can look at. There's a lot of different things we can look at. You have higher highs and higher lows. In fact, let's just do this. Higher highs. And let's just label all these different things that are important. You have higher highs and higher lows. higher lows, right? And then you have lower lows and lower highs, right? Lower lows. Lower highs. Why is this a price action concept? Why are these price action concepts? Let's find some examples of that just right here. So right here you have a high, right? Over here you start to have some lows that are just slightly lower than the previous lows. Right here you have a lower low than these lows, right? So if you think about it, this is a lower low, an LL right here, because it's lower than the previous low. And then over here you have a higher high, or excuse me, a lower high LH, right? Lower high. Right? So that's a price action concept. And why is that an important price action concept? Because if the market's struggling to make higher highs, then and then it's followed by a new lower low, then that's telling us that this market's pretty weak. It's struggling to maintain price action. That it would, if it was originally going up over here, was trying to go up, and then it starts to struggle in this area and confirms that struggle over here, there's a good chance the market's going to want to go down, right? So that's a price action concept. What are some other price action concepts? You guys name them out in the chat box if you know of some price action concepts. You have chart patterns, which is there's a lot of patterns. There's a lot of different types of chart patterns. You got things like an example would be actually let's write some of these examples out. So you have let's actually write this out. You have things like a pennant. Is that how you spell pennant? Yeah, pennant. You have flags. There's head and shoulders. Head and shoulders. There's triangles. Triangles. You have double bottoms, double tops. Something like that, right? And then what else do we have? Maybe one more thing. Um, what are some other patterns I'm thinking? There's M's and W's. People look at those too. You can I don't really look into those a lot, but you've got M's and W's. It's yeah, M's. I don't know how to do that. And W's. Some examples. Cup and handle is another good one. Actually, let's put that in there. Cup and handle. What are some other price action? Oh yeah, Roger says supply and demand. Yes. So that's another price action concept is identifying supply and demand. That's a little bit of a deeper concept that we're gonna get into. But at the same time, even though it's a little more in depth to try to find it, it's the essence of price action, isn't it, Roger? Liquidity. So, or supply demand, right? Yeah, so those I'd say those right there. We can continue, we could probably just have a big conversation on a lot of these. But and I forgot, yeah, trends. Of course, like trend lines is a big price action concept, isn't it? That's what we do every morning, isn't it? I'm forgetting all the stuff that we normally do, right? Trend lines. That's a price action concept. So a lot of price action things here, right? This is separate from the COT report. COT report, we can still look at price action, but the COT report, the cool thing about the COT report is you can trade it blindly. You don't have to even look at the charts to trade the COT report. But if you want to trade price action, then you better be looking at price. You got to be looking at the charts, right? So I would say all of these, and there's probably many other things out there that you could label, but I think this is kind of the main, these are the main points that you want to talk about. And I feel like some of these have higher precedence over other things, right? Some things matter more than others. So for example, let me ask you guys, for those of you that have been with me for a while, what are my feelings on chart patterns? Are they just my favorite thing ever? No, you guys know I'm not chart patterns. Yeah, not big into them, right? I used to be. Yeah, they're a bonus. Yeah, that's how you want to look at chart patterns. Okay. Don't become that person that sees a pennant or a flag and just says, I'm just going to trade a pennant or a flag. Okay. There's a lot of good trades you can take with chart patterns. I'm not going to deny that, but it really should be a secondary confirmation of what you already know. What really matters is what we've been talking about. Wesley brought it up, break of structure. You want to look at trend lines. You want to look at liquidity zones. Even the higher highs, higher lows, lower highs, and let's see, higher highs, higher lows, lower lows, and lower highs. That matters more than a chart pattern, I'm telling you. And often chart patterns show up as a result of price action, not that the pattern was the reason. Patterns are secondary to price action. They show up because of price action. Think about it. A head and shoulders. How does the head and shoulders form? You have to have a high that pulls back and another higher high that pulls back 100% of the retracement. And then a next high that's the last shoulder in the head and shoulders that comes up to the shoulder line of the other high previous to the one you're just looking at. And then the market goes down from there. It's because of price action that a head and shoulders showed up. It's not that the head and shoulders was the reason for the market to move so much. It was just as a result, right? Okay. So so yeah, like we were just looking at this chart right here. You have lower highs, lower lows. So let's talk more price action. So here's what I want you guys to do as a homework assignment, but also as something we're going to do together right now. Go back to any chart. I don't care what it is. It could be currency pairs, it could be crypto, it could be the stock market, it could be if you follow the bond market. Pull up any chart on any time frame. Go back and find the biggest moves you can find. So here's a big fat move right here. Okay. What led up to this move? Because there's a lot of money you could make. If you see a big move, whether that's a move up or down, there's a lot of money to be made there. So let's talk about the price action that led up to this moment, right? So let's go do a rewind on this. Let's rewind to, we'll say here. And you and I already know what happens after this, but let's find out what led up to this moment. Okay. Well, I can already see right here there's a trend line on this NZD franc, right? You got a nice little trend going on here. You have 1 point of engagement, you have 2 points of engagement. I would argue that that is a 3 point of engagement. And then the trend starts to break down right in this area. It's a break of structure, right? What else do we have going on? You have an apex high up here, and then you start to form lower highs. So you got a lower high, LH, right? Right here. Actually, a series of them. You have a series of lower highs right here. This is a low. This you had a low right here, and this market started to make a lower low, and actually a series of lower lows, right? So you have, let's write this all out. This is a BOS first. You have a BOS, which matters the most. That honestly, you guys, if you take anything away from this and my training, the BOS is the superior price action like analysis. Breaking structure matters more than anything you could possibly look at by far. There's nothing else. Wherever the market's breaking, whatever it's, if market breaks structure, that's the biggest signal. Why is that the biggest signal? If market breaks structure, that tells you, it tells me, and it tells all the other banks and anybody else who's trading in the market that that is the new direction. And so if you find an opportunity to go in that new direction, chances are your RR ratio is going to improve dramatically and all other things, right? So break of structure matters the most. Okay, next thing. I want to draw this out. You have lower highs, lower lows, I mean, LL. You have LL, right? You had an LL right here. Technically, you had another one right there as well. Okay. What's the price looking like right now? You have break of structure, lower highs, lower lows. What should that tell you? Not looking bullish, that's for sure. And then the market continues, does its thing, and then boom, off to the races, right? And just does a huge, just collapses from here, right? That's price action. Okay, let's go find another one. Again, what's the homework? Go and find the biggest moves you see on a chart. What led up to those big moves? So here's a big fat one right here. Big fat move, right? What led up to that? Well, let's do a rewind. Oh, if it'll let me go back to that. Yeah, right here. Let's do a rewind before that move took place. I think that was a news event, but nonetheless, let's break down the price action. What's going on, right? Let's break this down. Right over here, you've got a trend line right off the bat. And this should have signaled you way before that move even took place. But yeah, you can see you've got 0.1. That's 0.1 of a trend line. Right here, you've got 0.2, 0.3, which you have to have 3 points of engagement for it to be a trend line. Why 3 points? Why not just 2? The reason why you have to have 2 points of engagement is this. Number one, it's very easy to just draw trend lines just on your charts wherever you want to draw stuff. So you have to have some guidelines as to where you're going to draw everything. So if you do 0.1, anybody can draw 0.1. Anyone can pick 0.2, but you can't just pick 0.3. Why? Because once you have point A and point B, then the slope is set. Whatever slope you're going to draw, now set. You can't change that slope anymore, right? So back to good old math days, right, in high school. Once you have point A and point B, you can't change the slope. So if you get a third point of engagement, then it's confirmed that what you drew was in fact and indeed a correct and a valid trend line. Okay, so I have 1, 2, 3 points, and I have a fourth point of engagement right here. And that's awesome. You don't necessarily need that fourth point of engagement, but it certainly works. And it's awesome. We'll take it. And then you have a break in structure right here. And then you can see the market actually came back up to the market broke through this engagement and kind of traveled along the trend line. I've talked about this before, but if you have a market that travels along the trend line here, that's usually not a good sign. If it just kind of hangs out on the trend line, that probably means that you've got a market that is not bouncing off this trend line. So in all likelihood, it's just going to break that trend line, right? Oh yeah, Brooke says, I've also seen them referred to as point A, B, C. Can't remember what A, B were for, but C is confirmation. Yes, that's exactly right. C is confirmation, and you have to have at least 3 points for it to be valid. So this should already lead you on because you have a BOS right here. This should already tell you that yes, we are headed for a downtrending market at that point. Okay, what else can we dissect? Are there other patterns we can get? What else is going on? Well, you had another structure break right here. So I think Brooks wanted to talk about this a little bit more too today, and correct me if I'm wrong, but so you have another horizontal support resistance level. This used to be, it's funny actually, this used to be resistance. This line used to be resistance. You can see this was resistance back over here, acted as a resistance area. It was resistance right here, acted as resistance kind of in this area. And then it became support. It acted as support right in here. And it acted as, I guess it only acted as support once or twice there. So now we had a break of structure of the trend line, but we also had a break of structure as far as that support line goes right there, right? That's another price action clue because you have a break both in the trend line, but also as far as support goes, you have a break. So what does that tell you? Down. We're going to go down, right? Because you have the trend line breaking as well as support breaking around the same time too. So this is a very weak market. It's hard to forgive a market that's broken those guidelines. So what's likely to happen? A move to the downside. And that's pretty much what happened there. All right, pretty cool, huh? Okay, so let's actually go to a different chart. I wanted to use something different than what we have open there. Let me look at some of these other comments. I've missed some comments here. Roger says, find structure, number 1. 2, identify break of structure, find liquidity, launch your winning trade. 100%. That's the model. That's the recipe, guys. Go look at Roger's comment if you haven't seen it. That's the model I want everybody to be doing. And it doesn't have to be a trend line structure. It can be any type of break of structure. And the reality is, if you have a break of structure, there's probably a lot of other price action concepts lining up at the same time. You probably have other patterns that are lining up just as confirmation. You probably have higher lows and higher highs, or lower lows and lower highs as well, lining up at the same time of a break of structure around the same time. That's why I'm saying, guys, the number one leading indicator in the entire price action world is which direction are we breaking? Are we breaking up? Are we breaking down? Just read it, right? That's the number one thing. There's nothing better than finding structure. And then the next thing is, like Roger says, is identifying a zone of liquidity that's appropriate for the structure that's subsequently broken, right? Nothing better than that. Okay. Let's see. And then I missed a comment earlier from Brooks, what it is, yes, but not how to make informed trading decisions as far as if it's going up to a higher or lower because of it. Sometimes it'll break resistance, but make a down move. But why? I guess what I'd like to glean from this? Okay, so gotcha. I think I see what you're saying. One of the things that we've talked about recently, Brooks, is how to identify how strong a break of structure is, because some breaks of structure are like work better than other breaks of structures. Let's put it this way, not every BOS is created equal. So let's meet there first and understand that that's a truth, that just because a market breaks structure doesn't necessarily mean that you're going to get a return back to liquidity, right? Or rather, which liquidity will it return to, because you've got several options, right? That is a little bit harder to figure out, let's be honest, but can we narrow it down a little bit better? So for example, one of the things that we've talked about recently is if you can find a break of structure, like let me see if I can find you one that hits the example I want to. It also depends on how robust it was. So for example, right here, this pound yen had a major resistance zone right here. Let's actually analyze this just as an example. Okay, so you have a major breakout right here and a major resistance level that was broken right here. And look how robustly this market just broke through it. It was just boom, 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 just super high, right? What's the chance of the market coming back to this original area or zone where it broke out from? Not as likely anymore because it broke out so far. So it does take a little bit of there is some subjectivity to that, right? If it breaks out far like that. So you kind of have to meet the market where it is. So with something like this, you would probably look for liquidity zones in this area for pullbacks, because that's all you can really do when it broke out that significantly. Let's try to find another example of what we've been talking about. Okay, so yeah, here's another good example. So right here, you had a nice trend line, right? You had 1 point of engagement, 2 points of engagement. You had 3, and then a break structure right here in the trend line, right? You also had a higher low, right there, higher low than the previous low over here, right? All of that kind of led to this breakout. Now, this thing moved up like crazy. Not only did it go up, and break this BOS here, but it also broke this BOS that was over here, right? You had some resistance right here, and the market just broke above that, right? So when this happens, what's the chances of us getting the market to come back down to here? Not very likely, right? It's not as likely that it'll do that. Okay. So when this happens and you get such a robust move, you have to meet the market at other zones. So you do have a little bit of a zone going on in here, whatever, something, whatever this was, there's some back and forth consolidation going on in there. That might be a good area. You could certainly do a liquidity analysis. I'm sure that there was something back in here that was probably worth looking into. That one would have lost, but I'm sure there's something that you could have looked into right there as an entry. So basically what I'm saying is, depending on how big these moves are, depends on how aggressive you should get in. So with this one, it was very aggressive and long-standing and continued. So you don't want to wait for it to pull back too far before you wait to get in, because if you wait to get in too far, you may just miss the trade entirely. And that happens to all of us. It still happens to me today. So you just want to look for those kinds of clues to tell you how aggressively you should get into a trade. Let's try to find one that's not as aggressive. So we can kind of do the same thing, but um, I'm trying to find, let's see if we can find one that's not as aggressive. Um, this is one that would have failed actually. Let me show you an example of one that would not have worked. So right here, this one would have failed, and this is why you have to use a stop loss, by the way, because you could get burned on this. So this one, look at this. It had a nice trend line here. I think we can all agree to this. I think it's good to show you the ones that fell as well, right? Because it's not, nothing's perfect, right? So let's talk about one that would not have worked out. So you have right here one that had a trend line. You have at least 3 points of engagement. Then you have a break in structure right here. That's a break. Now, the interesting thing about this one, and this is the difference between the one we just showed you and this one, is it only broke, it didn't break above, this resistance up here. You had a nice kind of resistance zone right through here. Let's draw this out. It never broke above that, right? It just basically came up right to it, but not quite above it, right? And then you have, here's your BOS as far as the trend line goes. But notice how this one did not break above this resistance, and you'd think it'd be easier for the market to do that, but it didn't, right? So with this one, you don't want to be aggressive with your entry. You want to look for lower levels to get in. You don't want to get in as soon as it comes back and retest that trend line because it's not a robust move. If this thing were excited, it would have not only broken this line, but it would have just continued higher. At which point you want to be more aggressive. If it does that, you want to be more aggressive. Like as soon as it dips, basically any little dip into a demand, you want to buy it. But with this one, it broke structure barely. And when it was met with another level of structure here, this resistance zone, it it fell apart. Like it didn't do it. It just didn't break through it. So what was the end result? Well, I think there was a news event involved with this. That's a huge move. Like that's only a news event that can cause that. And I don't know what news event that was, but sure enough, it pulled back significantly. So if you were to have traded this because you didn't break above that resistance, you would have still looked for a buy, but you would have waited for it to maybe pull back into maybe a deeper demand level. You don't want to be as aggressive when that happens, right? Okay, so there's an example. Shall we look at some others? Yeah, we can go. What currency pair do you want me to look at? We can go look at pretty much anything you guys want. Yeah, let me know if you guys have a currency pair you want me to look at. I'll just go to the euro dollar if there's one. Yeah, okay, euro dollar. Let's do that. Now, we trade a lot of trend lines, don't we? Can you trade structure just based off of any break? Yeah, you can. So right here, and here's how I would trade horizontal support and resistance breaks of structures. So for me, I would probably have you guys focus on the ones that break pretty clear support resistance. So for example, let's see, can we find a pretty clear support level? Yeah, this is support right here. Yeah, so you've got a nice support right here on the euro dollar, right? 3 points of engagement. You don't necessarily need that, but I would try to just do the same thing when you're trading support and resistance and not trends. Just try to find clear cut, you know, at least 3 points of engagement. Okay. Once you've got that, what's next? So now you've got structure. That's number one. Number two is you need the break of the structure, which happened right there. That's pretty robust. Like that's a pretty big move. Okay. to move like that. So that's your BOS. So same thing. If it breaks through pretty cleanly, should you be pretty aggressive at getting in? Yeah. And it actually kind of stinks because it looks like it came right back up to support and which is now resistance and it pulled right down. So that's a good little trade. That's pretty much well it's already on its way. But what are some other levels you could get in at, guys? So it looks like this market, because it was so robust and so aggressive, it moved down for pretty quickly. But I would have looked for an area probably right in here to sell at. That still might be a good place to sell, but that would have been my ideal area. Why? Because whatever orders took place in here ultimately led to this market's demise. Whatever took place in there. So that's got to be liquidity. Good place right there. Let's go find another one. Okay. Let's go find another good one. Let's delete all this. A lot of these are news events. You can see huge news events, big moves. Also, like when you see a big move like this, big fat move, you you and I both know there's liquidity right here. But do you think the market's going to get back up to that anytime soon? No. So what do you do when you have that problem? You can see if the indicators will give you anything else, but you typically have to go find liquidity from other places. Like, so this market actually came up to here. That's where it went. Let's draw this over. Why did it stop there? Is there any liquidity here? Yeah. Basically, the demand liquidity turned into sell liquidity right here on this flip side over, over here. Um, I feel like that's harder to do, and that's a little bit of a deeper concept to try to pinpoint that kind of stuff. So when I see big fat move like that, I get a little bit skeptical on how I'm going to trade it because I don't know how it's not the way you'd want it to look, if that makes sense. Oops, let's go ahead and delete all that. Let's go look for one more. Okay, this is really good. This is a good one. This is a very well-defined support level. See this? Very defined. Nice support. Let's draw all the support zones, right? You got support, support, support. I'd call that support too. It's a defined level. And then look what happens right here. Boom. BOS. Right? Soon as that happens, what are you supposed to do? Here, let's rewind this. Let's go back to here. As soon as that happened, we got an opportunity. Okay, because now the market has signaled we're done with this up. We were up for a while. Now it's over. We broke this support zone. We're ready to make our strides to the downside. This means if this happens, there's a huge RR opportunity. Your risk to reward is going to be fantastic if you can find this. Okay. Okay. So what do you do? Well, you can use these indicators like the order block indicators and find liquidity. And sure enough, there's, tons up here. There's some right in here. You can use those. But I want to teach you guys how to do it manually. Other things you can look at. Here's a high. This is your apex high. Got another high right here. And we're forming lower highs, right? Lower highs, LH. Lower high, lower highs, right? Got lower lows. Got a low right here. These lows are lower than the previous low, so let's type that out. Lower lows. And that is this right here and this right here. So now what? Okay, good. We know that we're breaking structure. We got lower lows, we got lower highs. This is a good price action setup. So where do you sell now? That's the big question. Do you sell just right now? You could. Could you do it better? Yes. How do you find liquidity now after you find a break of structure? That's the big fat question. Okay, here's how you find it, guys. Follow the move backwards. So if this is the move that broke structure, follow it backwards. Find liquidity. Well, this could be some liquidity right here because whatever they did here led to this market move to the downside. You could also say, honestly, this whole area is liquidity because this big contraction is where the market was moving back and forth before it just fell off. This whole area is liquidity. So basically from this high to this consolidation, all of that's sublime liquidity right there. That's a massive selling opportunity, massive selling area. So now what you do is you look for a short, right? Basically enter at the start of this. Some people like to wait for it to go halfway through or something like that and then do it. I'm just going to start it here. And then you can ride this thing down however far you think you can get it. You know, it probably looks for some liquidity down here like that to close your trade at, something like that. And then you wait. So once you have this all set up, you have your break of structure, you found your liquidity, you got lower lows, lower highs, all that price action, good stuff. Now you just let the trade go and play out. And this one, sure enough, like this one, I'm pretty sure this one came right up to that line. Came up to the liquidity zone. Here it comes. I'm pretty sure it came up here and then, yeah, so it's triggered in. It went about halfway through this zone and forms another lower high. As you can see, that's another lower high. And then it's just off to the races, right? Boom. Okay. So that's what you want to do when you're trading price action. What's the number one thing? Break of structure. Nothing beats break of structure. Okay. Nothing. And then you want to find other things on top of that. Like, are you breaking trend support? Are you breaking, you know, a major horizontal support resistance zone? Great. Do you have lower lows? Do you have lower highs? Is there a pattern forming? And then the last thing you got to do is locate liquidity. How do you find liquidity? Follow the market backwards from the move it made and go find the consolidation that created that break of structure, which we identified as this whole area. Whatever took place in here created the break, and that's why that's a good selling area. Okay. All right, guys. So that's price action and basics in a nutshell. This class is recorded. It will be uploaded. Give it about 30 minutes. So if you want to come back and watch it from the beginning, you can. But I'm going to go ahead and wrap up. Are there any other questions? And for those of you on YouTube watching this, if you are not a member of the program and you'd like to come to all these classes and you'd like to take the trades we post on Telegram, just like this, there's a link down in the description below where you can become a member. There is a 14-day free trial you can get going on. If you want to join my mentorship, that is $195 a month, and that's an opportunity for you to work with me one-on-one. And there's a link to that down below. So, all right, guys, appreciate your attendance today. Thank you for coming. Have a fantastic rest of your day, and we'll see you guys in the next webinar.